Everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are posting. I did post some stuff myself, so we can go over some of that stuff as well. I'm going to give you my financial opinions. It's going to be related mainly to wealth building, commodities, and financial topics. So let's dive in. Let's see what Twitter's talking about and give you my opinions. It's at finding_finance. And we've got finding-value.com if you want to join our community. We've got a 5 p.m. Sunday question and answer session, which this is being released on Sunday, which is today. Scrolling on down. So we've got uranium, some ratios here. URA, so just some takeaways. URA has a long way to run against SPX. URA broke out against gold, and URA is cheap against commodity pricing. So the commodity itself, I should say. So here's UAA versus SPX. You can see this gigantic decline, and we're bottoming out, it looks like. We can zoom in on some of this as well. We've got URA versus gold. You can see that we've broken out against gold of this falling wedge. We've got URA versus the Dow Jones Industrial Average, another wedge that's breaking to the upside. That's good. URA versus the commodity itself, very, very low here, guys. This is a very good opportunity to be looking at URA versus all those other things. I use URA just because it has data going back for many years. Uranium is the same thing, and it's signifying or signaling that the uranium ETFs are cheap. That's what I'm trying to get across here against everything. The Kobayashi letter says, homeowners are now spending a record 40% of their gross income on their mortgage. This is above the 2008 high of 39% and up sharply over the last 2 years. After paying income taxes and mortgage costs, most homebuyers have less than 30% of their income left. This is concerning. So that's what they are saying. Now, I have a brain, and I don't believe that. I don't believe this data here. And I'll break it down why I don't believe it. But here's the data. It says debt to income ratio for all home buyers. Up, down, and then up. All right? Well, we know that we've got really low sales volumes right now. Very low. And what they're doing, my guess is what they're doing, is that they're saying homeowners, which it's not really homeowners. What we need to be looking at are what are people buying today and what are the buyers of today. It's not homeowners. New homeowners that are just buying stuff. And then they go into are now spending a record 40% of their gross income on their mortgage. My bet is that they are taking debt to median average or something like that income. Is that really the people that are buying the homes? I don't know. Maybe they're completely off. Maybe everyone who's buying a house today is in the top 20% earners, which means that this statistic is completely wrong and they are misleading you. We don't know what the actual gross income to debt is unless they are actually taking the data of each one of those people. This is homebuyer debt to income ratio is averaging close to 40% in 2023. Those are near the worst affordability levels on record according to this. The thing is, I don't know if this is accurate information. You can't take an average income and then apply it to people buying homes today. We are in a massive shortage, and the people buying homes today are not the average person. They're going to be in the top 20% or something like that, which means that these debt to income ratios are completely off. So just be careful when you read data. I don't know that these guys who post all this know what the hell they're doing. Like, I do not know if they know that they're calculating this right or wrong. And that's why when I look at a lot of the data, I'm like, I don't know if this is accurate or not. You know, back here, we had a lot of volume back here. And this was probably a more accurate measurement than the measurement is over here. And why do I say that? Because everyone was getting loans back here. Not many people are getting loans over here. Not many home sales are being transacted. We had massive transactions over here. We also had a bunch of new homes that were built. We do not have that on the right-hand side. So I'm hesitant to take this data at face value of what they're saying. Because if the majority of people that already are in homes, that are homeowners, they do not have anywhere near this gross income. And since the sales volume is so low, I am willing to bet that this data is wrong and that the debt to income ratio is not actually that bad. And that even if it is that bad, there's hardly anyone that has it that bad. It'd be very few individuals because the sales are down so much. Yep. Talking about a video I released. Take that, OPEC, at Joe Biden. U.S. cuts production with OPEC. So you can see that United States DOE crude oil total production is declining. We went from 12.2 down to 11.9 million barrels. Is this going to continue to fall? I don't know, but we're cutting production. I don't know if we're purposefully doing it or if it's just by happenstance. Difficult to say. Scrolling down, how come so few investors want to own energy stocks? This is Energy XLE from JC Parrott's All-Star Charts. Nice big move higher, and it looks like we're ready to break to the upside here on this energy chart. So looks good. Looks good. And this almost looks like wave 1, wave 3, and then almost a wave 5. Maybe this is all wave 1 still in progress, which is possible. That could be possible as well. So let's be honest. What the Fed needs to do is stop inflation, is to take rates to 8 to 10% with a sledgehammer. The problem is we can't afford to do it thanks to the national debt and our inability to service it. Powell sucks and he's weak. It's not all his fault, though. Well, I agree it's not his fault, but he's in a pretty bad predicament. A predicament is you have to handle outcomes. There's no solution here. So if he takes it up to that, what he does is he will slow down bank lending in the system. Problem is that national debt at 8 to 10% is going to be throwing off a lot of interest payments. And it's going to be inflationary any way he goes. Because the debt, the fiscal side the debt will be the inflation driver on this. And if he doesn't raise rates, then the credit expansion is still there. And it's a combination of those two things. I write, it's a bird, it's a plane, it's uranium price. We do have a breakout here. And maybe we're going to enter the fly zone here soon. Fingers crossed. Let's hope that is what happens. I said for the uranium squeeze, the big boys are running, Camco and those. Look at the lagging companies. A lot are sitting right next to falling wedges. The opportunity is here and now, in my opinion. Gold. We've got gold that's sitting on top of a flag pattern of a cup and handle continuation pattern. Commodity is going to fly. So gold is kind of our leader. We're kind of waiting for liftoff there. We're seeing a liftoff already in oil. Uranium's breaking out. It looks pretty good. I don't doubt that some of these banks or whatever are trying to manipulate this lower. This here is going to be the signal. We're sitting on top of the pattern just waiting for the move now. And they're probably going to try to slow this down as much as they can. We've got oil looks solid and heading higher. Nat gas might be rotating around higher. Money rotation engaged. So we've done our retest here. Starting to move on up for oil. Nice big bull market going. And then it looks like we're trying to put in some sort of roundish bottom where nat gas could outperform as well. So nat gas and oil looking good. And obviously uranium's looking good. Here's URNM breaking to the upside of its pattern, heading into the fly zone perhaps. And then we've got URNJ that also looks pretty darn good. Let's hope this rips here, guys. I'm locked and loaded. I'm ready to go. You got what I need. Great recovery day for most uranium stocks that were down yesterday. And it's a big bullish engulfing here, guys. This is on you. You've got a good chart pattern is what it's got. Good bullish engulfing. Let's hope it runs. Odd thing to happen before a housing market crash. I think he's joking. U.S. mortgage delinquency rates have fallen to an all-time low. There's no forced selling in the markets. So I don't think we're going to get a housing crash. And I think Joe's obviously highlighting that. How much have American families have saved for retirement? Nearly half said zero. Why do you think this is? Well, I don't know where this data is coming from. But I know a lot of people really don't care about saving money. I would talk to a lot of individuals over the years, and they would say, well, you're going to die at some point. Why not just spend it all? And maybe that's the case that they're going to do. Maybe that's their opinion, and maybe that's what they want to do. I don't know. So my opinion is I think some people don't want to save. They actively don't care. And I think that's probably the majority of the 49%. And then you've got some of that 49% that maybe can't save. I think the majority just don't care. That's what I think. You were just handed $1 million and have to pick one ETF to buy. What would you buy? URNJ, maybe. I would choose between URNJ, OIH, and PSCE or XOP or something like that. So I've got one energy service company, ETF, one uranium, and one exploration production company, ETF. That's what I would choose between. I don't know which one I would choose. URNJ is swing for the fence. If you want to swing for the fence, perfect. But it is $1 million. Probably don't want to lose it. URNJ is a more speculative position. If you choose something like XOP, those guys are cheap and they're cash flow rich. And then you've got energy service companies, which are also cheap and cash flow rich. If I had to put all $100 million or $1 million into one, I'd have to go with the cash flow rich companies. I can't be that speculative if I have to put all of it in one shot. So I'd probably pick OIH is probably one that I would choose if I had to. Otherwise, I'd divide it up and kind of spread it out. W-2 is the worst way to earn income. So that's like basically W-2 job. But you still have options for reducing taxes. You can max out a 401k, 403b, reducing your taxes. Backdoor Roth IRA, which is not really reducing your taxes there. Mega backdoor Roth. Donor advised fund, real estate professional, short-term rental, HSA, FSA, tax loss harvesting, and a 529. What did I miss? I don't know. I think that's probably a lot of it if you're a W-2 worker. I do take advantage of 401k. I do take advantage of a backdoor Roth. And then I do take advantage of a health savings account. And I do tax loss harvesting to reduce taxes. If I mistime something, I'll sell it, move it to a different account, and buy the same stock in the other account. I do that sometimes. And then take the loss in my individual account. Tax loss harvesting. These are cities I would immediately consider living in with good business job offer. Miami, New York, Tokyo, Hong Kong, Dubai, Paris, London, and Barcelona. What are yours? Well, I can tell you I don't want to live in any one of those. I'm not a big city person. And most of those look like pretty big cities. If I were to choose, and again, guys, I'm not well traveled. I will say that I've been around mainly the United States, places in Canada, and I've been to Mexico once. All right. So if I had to choose, I think I like where I'm at. I think it's a good, I don't know, middle ground of everything. Taxes, weather. We get a little bit too much hail. I do agree with that. It can be a little bit volatile in terms of the weather, but I don't mind it. It's real dry. It's sunny. We're at elevated desert, so to speak. So I kind of want to be where I'm at. And I'm not in a huge city. I don't want to be in a big city. I want to be in something that's, a couple 100,000 or so, and that's it. I don't want to be in the middle of nowhere. It'd be nice if I could get lower taxes, obviously, but that's where I would choose. Peter says global oil demand is setting record highs, just as supply gaps down on deep OPEC production cuts. That will prove an explosive cocktail in the coming months as visible inventories plummet. Energy will be the key market story of the second half. I agree. Let's hope that turns out that way. We have Wolf, big old Wolf here. Over the last 20 years, the S&P 500 has returned 9.752% per year. That means $1,000 invested 20 years ago would be $6,400 by now. $20,000 would be a whopping $127,979. Compound interest is incredible. What I'm going to say is this. What is our actual inflation rate? What is it? Because you should take this out and inflation adjust it. I'm willing to bet that the S&P 500 barely beats inflation, if it beats it at all. I think our inflation is probably in the low times 5%, maybe 6% at least. And now it's probably, I don't know, 10% or something. And where it gets you is prices are going up and they keep shrinking everything. I mean, I can remember, this is a long time, a good while ago. I swear to God that the toothpaste, those toothpaste bottles, they had to have been at least like 9 or 10 ounces back in the day. And now I look at them and they're like 6 ounces. And they're a lot more expensive. So the price has gone up and they've also dramatically reduced what's in the actual package. He says how to build wealth. Create a budget, take 401k match, pay off high interest debt, build a 3 to 6 month emergency fund. Get term life and disability insurance, max out HSA, Roth IRA, contribute to taxable brokerage, live life. Another way to build wealth is to take money and invest it into a business. The people who build massive amounts of wealth are generally those who open up businesses. And the businesses can grow faster than anything that you've got over here. This is more of a way to save money and invest money. You can invest and build wealth, but I also think you can build wealth by building a company. That is the fastest way to building wealth, is to create your own company, go out there, provide a service or a good, and grow it like heck and reinvest in it. That is bar none, the fastest way to do it, is to increase your income or your profits from a business. I know some people that I went to college with, they all did it that way, who make the most amount of money. They built businesses, what they did. CCJ, Hoover Dam has broken. Watch out, folks. So this is Camco. You can see that we are rocketing higher. He is estimating perhaps a 244% increase, which is around $92, which is probably a good bet. And that's where I'm going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We do have that question and answer session coming up at 5 p.m. today, Mountain Standard Time. There's a Zoom link on the website. Once you sign up, you'll be able to see it. Not too hard to get there. And I can show you guys, if you do sign up, just ask me and I can show you how to navigate the website and have our Discord channel and all that other stuff. But that's what I've got for today, guys. Hopefully everybody has a good day. We'll catch you next time. This is Finding Value.